Hey there, welcome back to our channel. If you've ever wondered how banks make money and why they pay interest on fixed deposits, you're in the right place. In today's video, we'll dive into the fascinating world of banking and uncover the truth behind those interest payments. But before we begin, make sure to subscribe to our channel and hit the bell notification so you won't miss out on any of our upcoming videos. Let's get started. To simplify the real-world scenario first, let's move to an example. Martin walking into the Union Bank and depositing $2,000. He receives a valuable certificate stating a 10% interest rate. Now, you might be thinking, why would the bank pay him an extra $200? Is it a loss for the bank? To understand how banks pay interest to their depositors, we need to take a closer look at the internal systems by which banks function. You may know that banks have two main functions: dealing with depositors who want to save money and providing loans to those in need. When Martin deposits his $2,000, the bank doesn't simply lock it away in a safe. Instead, they use that money to provide loans to others at a higher interest rate than the deposit rate. You see, banks earn a profit by capitalizing on the interest rate difference between loans and deposits. Let's say the bank offers a 20% interest rate on loans. After 1 year, they would earn $400 on the loan while paying out $200 in interest to Martin. This results in a clear profit of $200 for the bank. However, banks do not function in a riskless background. In fact, they face significant risks irrespective of how strong their management policies. This risk is compounded when they do not implement proper policies to manage their deposits and loans. In other words, their assets and liabilities. If the economy is unstable and government changes their regulations, it may lead the banks into many risks. In cases where a large number of depositors decide to withdraw their funds, banks can face challenges. This is why banks employ financial analysts and consultants to mitigate risks and ensure their stability. However, there are many aspects that the banks should pay attention. For instance, they deal with the timing mismatch between deposits and loans. In cases where a large number of depositors decide to withdraw their funds, banks can face challenges. This may even result in bankruptcy of the bank. To avoid such risks, banks have implemented management systems. Central banks enforce rules that require banks to keep a certain percentage of deposits as liquid reserves, usually around 10%. This reserve ensures that banks have enough money on hand to handle various situations if needed. They can also borrow an additional 10% from other banks. Finally, the central bank acts as the ultimate backstop, ready to provide an extra 10% if necessary. These measures allow banks to maintain approximately 30% of deposits as liquid assets, ensuring their ability to handle any situation. And there you have it. Now you know the inner workings of how banks make money and what they do with our deposits. It's a system that has been in place for over 150 years and has proven to work effectively. So, no need to worry. Understanding the banking system empowers you to make informed decisions. If you found this information helpful, be sure to subscribe to our channel and hit the bell notification for more exciting financial facts. Thanks for watching.